Hi, everyone. Thank you for attending. Just a few housekeeping rules today and notes. For CPE credit, please be sure to complete at least 3 of the 4 polling questions in order to receive the credit. Your handouts can be found in your toolbar on the right, as well as the question box that you can please use throughout the presentation, and we will answer the questions at the end. Now I'm turning it over to your presenter, Al Erdman.
Thank you, Ali, and welcome everybody. For, I guess, the handful of you that do not know who I am, my name is Al Erdman. I'm a partner out of the New York office, primarily focused on the real estate and professional services industry, but 6 years ago was also dubbed the 842 guy, because when the new lease standard came out, they said, well, leases, that must be real estate, so let's give it to a real estate guy. And as it turns out, as most of you are realizing, this affects just about everybody except real estate, because the rules for the landlords are virtually unchanged. This affects tenants, which is pretty much every other industry than real estate. But nevertheless, we have stuck with it, and I've been speaking about this topic for several years now. And I was asked to speak to the nonprofit group specifically about how it will impact the nonprofit industry. So the session today will be a little bit of a refresher from my December seminar, but I've also added some stuff that is specific to nonprofits. So hopefully I will answer your questions. But as Ali said, if you have questions during the session, spit them out, throw them up on the question board. We will try to answer them as they go. You know, I like to keep them on topic. So if there's a question about a specific slide, I'll try to address it right then so it stays relevant. But with that, let's jump in. Okay, so just a reminder of the effective date. Okay, it is for fiscal years beginning after 12/15/2021, which is calendar 22. Okay, but now, as you know, a lot of nonprofits have fiscal years, so it is only those that fiscal years that are beginning in 22. So you know, a very common year end is June, so July 1, 22 will be the first date of effectiveness for nonprofits. However, take a look at this. For non-public companies, the interim periods are only for the next fiscal year. So even though the standard is effective, we'll stick with July 1, 22 for a nonprofit, the interim reporting for anybody who does interim reporting, be it quarterly or semi-annual, that does not go into effect until next year. Of course, you can voluntarily do it earlier, but you're not required to report on an interim basis until the following year. So as it says, technically you don't have to do it till next season, but we should recommend that clients do not wait to comply. And as I said earlier, adoption is permitted. So as a reminder, we do have an 842 group that works as a consultant to our other audit teams. We are not expected to do all the calculations for you. I mean, there's just far too many clients and leases in the firm. We couldn't possibly do them all. We are for hire for specific projects, maybe a very large project where the client is engaging us to do a large calculation. By that, I mean 50, 100 leases. We can also address the unusual questions that may arise. But by and large, each audit team will be expected to be able to handle your standard run-of-the-mill leases, you know, one location, you know, one building, one office space, whatever it may be. Just keep that in mind. Okay, so there are some exceptions to reporting under 842. First one being short-term leases. Okay, a short-term lease is one that at the commencement date has a lease term of 12 months or less and does not include an option to purchase the asset that they are reasonably certain to exercise. We'll talk about reasonably certain in a moment. Lease term, you notice that's an underlined term that's defined. It is the non-cancelable period for which the lessee has the right to use an asset together with all of the following. Okay, periods covered by an option to extend that the lessee is reasonably certain to exercise that option. Again, we'll define that in a moment. Periods covered by an option to terminate that they are reasonably certain not to exercise. Okay, Also, periods covered by an option to extend where the option is controlled by the lessor. So if the lessor can opt to add a year or two onto your lease, that has to be counted. So if you have any of these clauses in your lease, they need to be considered. So for those thinking right away, well, I'll just sign a 1-year lease with 9 1-year renewals. That's not enough. You need to evaluate the likelihood of exercising any of those options. And once you factor in the cost of moving, which is not cheap, as I'm sure most of you know, cost of moving between personnel, furniture, IT, hardware, software, cable lines, everything, moving is not cheap. So it's not very likely that a person's doing a one and done lease, with some exceptions. But generally speaking, a one and done lease really wouldn't happen. We'll cover related parties, or in case we don't, related party leases are not a little different. They're still handled the same way. Thing is, if you're simply a month-to-month lease, that may qualify. What's also happened with a lot of related party leases, the advice has been just tear up the lease and have there be no lease. Okay, since you do control both sides, the absence of a lease is not as threatening as one with an unrelated party. But there are no exceptions to related party leases in 842. So a related party lease is treated just the same as any other lease. So it is quite possible in a related party situation just to tear up the lease and not have it be an issue. So what's our takeaway here? Okay, so even if a short-term lease is excluded from the liability, you are still required to disclose the total expense for that. So again, it's not that it's not a lease, you just don't have to capitalize it, but you would still have to disclose the expense thereunder. Just a little note on short-term leases. So what is reasonably certain, right? I mentioned it a couple times. This was changed from reasonably assured simply to conform to IFRS standards, International Financial Reporting Standards. The lease standard was one of several projects undertaken between the US FASB and IFRS, or the International Accounting Standards Board, so the FASB and the IASB, to better align the US with international standards. And when 842 came out in February of 2016, the international standard came out in January of 16. So again, it was a concerted effort to better align the accounting standards between the two bodies. Of course, they came up with different standards, and we'll talk about a little bit about them as we go through. So it was changed from reasonably assured to reasonably certain, and that's meant to be a pretty high bar, 75 to 80%. So in order for a renewal option to be considered, it has to be 75 to 80% likely that you would exercise the option, okay? And I'll draw a comparison of this to more likely than not, right? We used to use more likely than not a lot. More likely than not is, just greater than 50%, just tipping the scales. And when you look at likelihood, especially the further out you go, you have a 10-year lease with 2 5-year renewals. Well, what is our likelihood 10 years from now? I mean, honestly, who knows, right? I mean, plenty can happen. All right, and even if there was a substantial capital investment in terms of improvements and equipment and such, 10 years is a long time, and a lot can happen in 10 years. The company can grow, the company can contract, company can buy another division, can sell off a division. A lot of things can happen after 10 years. So just sort of anecdotally, looking out 10 years or so, or even more than 10 years, to reach 75 to 80%, in my opinion, is pretty high. Pretty difficult. Pretty difficult to get that high a bar that far out. But if you've got a 5 and a 5, or a 5 with 2 other 5s, or a 3 and a 1 1 1, in a short term like that, likelihood would probably increase. So you need to evaluate the factors, and of course it's a case by case situation, but you will want to evaluate your client's situation. All right, I see a question here. Can the total of a short-term lease be disclosed in the notes, or does it have to be on the statement itself? Absolutely, in the notes is just fine. There can be just one line item for lease expense in your financials, whatever it may be, and you can have, because you'll see, I don't know if we'll have time today, but there are a lot of disclosures in here. So among the disclosures, you would show the fixed component, the variable component, as well as the short-term component in the notes. So yeah, it's very, very common to see something of that in the notes. In my expanded presentations, I do have a lot of disclosures in there. You can refer to those. The last one of those was early December. So feel free to search the Witham Learning Library inbox for the lease update in December. You'll see the full slide deck there, and that has a lot of disclosure examples. But yes, in the notes is absolutely acceptable for that. All right, come on, go over here. Okay. So takeaway here. So as I said, the likelihood of including renewal options is not that high, but also remember it's management's conclusion to make. Okay. Oh, there's something else too. We talked about disclosures. Again, this is management's conclusion, and if we're auditing it, we have to, evaluate the reasonableness of that conclusion. And one of the many new disclosures is to first not only disclose the existence of a renewal or a termination option, but also why or why not the option was included in the calculation. So again, more transparency in terms of getting readers to be able to evaluate companies comparably between the two. We need to know these types of things. Maybe company A included renewal options, maybe company B did not, so that has to be evaluated. So you have to tell the reader whether or not you have renewal options and why you did or did not include them in the calculation. And look, uncertainty is an acceptable reason. Look, it's 10 years from now, and we honestly just don't know. Are we 50-50? Possibly. But unless you reach that 75 to 80% level, you would not include it. And you would have to just disclose, yes, there's a renewal option for another 5 years. This has not been included in the calculation due to the uncertainty of future events or something along those lines, but you do have to disclose that as well. All right. Another exception, low value leases. Now, this is the first divergence between US standards and international standards. International standards set a bright line $5,000 threshold for exempting a lease from treatment under IFRS 16. IFRS 16 is the equivalent of ASU 2016-02, or what we know as ASC 42. Very strict. If the net present value of the payments under the lease is under 5,000, you don't have to include it. You can, but you can elect not to include it. US standard has no such threshold, but they do admit that materiality still applies. Okay, so what's our takeaway here? In applying materiality, you should consider the overall effect on the financial statements in the aggregate. What that means is, yes, you may have, I just had a call with a client last week, you may have a lot of equipment leases that are just very small, be it copiers or something like that, maybe $3,000, for, a high volume copy or something like that. But if you have 100 of them, there, now you're talking a $300,000 liability that could be missing from the books. And by and large, that's probably a big enough number or material number, to most statements. So that has to be considered. So for me, I wouldn't just be looking at a specific asset. It would be more class of assets. So if you had a lot of truck leases, which would be pretty expensive, and some copier leases, you can say, okay, look, I'm going to take the truck leases, which are equipment, but they are significant. I'm going to capitalize those. But I have these 5 copier leases, that together make up, 20 grand. That's not really a lot. You can choose to exclude the class of assets being copiers from your calculation, because as a class of asset, they are not significant. But if you had even one, even it's a class of small assets, if there's a large number of them, I think that has a material effect, and you should consider that effect in the aggregate, not just lease by lease. Where again, international standard says 5,000 per asset. I think that's a bit short-sighted, but nevertheless, that's what we have. All right, just some other exceptions. You can take a look at them. Leases of intangibles, right? So any of these software licenses you see out there, not a lease. Leases of intangible assets are not counted. Leases to explore for minerals, oil, natural gas, so on. Lease of biological assets, which includes timber. Leases of inventory. Leases of assets under construction. None of those fall under the scope of 842. And it's time for a polling question.
Watch and read it. Hi, everyone. Here's the polling question. A nonprofit entity has a 6/30 fiscal year end. What is the first period for which they must account for lease under ASC 842? Just a reminder, you have to answer 3 out of 4 polling questions for CPE credit.
All right, numbers looking good so far.
We'll give it a couple more seconds here and then share the results. %. Is that the right answer, Al?
So yes, so we have 90% saying the year ended June 30, 2023 is exactly right. Okay, for the couple that picked the quarter ending 9/30/22, remember interim periods don't start till the following year. So that is not the case. And for the 2%, probably one person who said nonprofits are not subject, I would like that name, Allie, because nonprofits are absolutely subject to 842. And thankfully, nobody picked whatever they want. So yes, year ended June 30, 23 is the correct answer. Okay, hang on. There we go. So let's talk about the definition of a lease. You never really thought we would have had to do that, but this definition is never more important than it is right now. Topic 842 defines a lease as a contract or part of a contract, which is very important, that conveys the right to control the use of identified property, plant, or equipment, which is known as an identified asset, for a period of time in exchange for consideration. Okay, a lot of key things in there. I'll dissect these a little bit. We have some case studies, but we'll go through it. Okay, a contract or a part of a contract. Okay, so it doesn't have to be just a lease of an asset. It could have other components as well. We refer to that as an embedded lease. We'll talk a little bit about those. That conveys the right to control the use of the asset. We'll talk about right to control. And also the use of identified property, plant, or equipment has to be an identified asset. Okay, so for anyone who is familiar with the concept of leased employees, right? You talk about these PEOs and such, they refer to them as leased employees. Okay, people are not property. The leased employee concept is not a lease. That does not count. Forget about it. Don't consider it. It's just not a lease. It has to be a hard asset, a physical asset. Okay, for a period of time, which means there's a set time period, in exchange for consideration. That is particularly important in the nonprofit world, and we'll talk about that. Okay, so a lot of pieces in that one little definition that all factor in, and we'll talk about at least some of them. Okay, so let's keep this in mind as we look at some case studies. So case study number 1. A donor unconditionally promises to provide not-for-profit A with free use of warehouse space for 3 years, beginning January 1, year 2. Nonprofit does not pay the insurance or taxes or any non-cash consideration to the lessor. The unconditional promise to provide a space is considered to be fully collectible. Okay, so there's no issue there. Warehouse space is an area of town undergoing economic revitalization. Rental values are increasing at above market rates. The undiscounted fair value of the free rent comes out to $69,000. Okay, see 20, 23, 26. Discounted at 5% down to 62,000 and change, and the NFP is responsible for utilities. Okay. Is this a lease? All right, I'll give you a second on that. Is this a lease? The answer is no. No for 2 reasons. One, there's no consideration, right? Remember, I said that the last part of the definition of a lease is in exchange for consideration. There's no consideration given here, okay? Now, for those that are saying, well, they do pay the utilities. Okay, yes, they might, but the utility is not paying for the use of the space, okay? The fair value of the rent is what would have been for the lease. The utility is something different. It's a service, has no bearing on the asset itself, or no relation to the asset itself. Yes, I know you use the electric in the space, I get that, but it's not for the use of the space, not the least of which the utility goes to a third party. It goes to the energy provider. So for a not-for-profit, because I know you have a lot of these out there, right, the nonprofits, when they get donated space, those are not subject, those are not considered leases for purposes of 842. They are not considered leases for 842 when there's not any consideration. So donated space. All the rules for accounting for the donated space remain the same, right? You know, come up with the fair value, debit, rent, expense, credit, contribution, income, all that stuff. But this is not a lease and would not be subject to 842. Okay, case study number 2. Donor unconditionally promises to give not-for-profit A discounted use of the warehouse space for 3 years, beginning year 2. They're providing it at a below market rate of $5,000 a year. There's no non-cash consideration, so it's only the $5,000 they're paying. Okay. Same fact pattern otherwise. Fair value of the rentals considered to be $69,000. You know, undiscounted. Warehouse space is in an area that's going up. Unconditional promise to provide is considered fully collectible. Is this one a lease? Okay, and hopefully you're seeing the answer to this one is yes. Okay, there is consideration. Yes, it's below market. Yes, it's a discounted rate, whatever it may be, but there is consideration. Okay, so, and what's also interesting in this, I don't know if I have a slide on it, but you only count the consideration piece in your 842 calculation. So the $5,000 a year is all that would go into your 842 calculation. The remaining piece, the undiscounted piece that is still there, that continues to be accounted for under your not-for-profit rules with the debit, rent, expense, credit, contribution, income for the remaining piece to bring it up to fair value. But when there is consideration, then you have to account for the consideration under 842. Now, in this, smallish example, if the 5,000 ends up being immaterial, you can use the materiality exception. But generally speaking, just to illustrate the point, if consideration is paid, that portion is subject to 842. All right, the right to control the asset, right? I mentioned this before too, is very important. In order to have control over the use of the asset, that means that the customer has both, okay, there's a hint, both the right to obtain substantially all of the economic benefits from the use of the asset and the right to direct the use of the asset. Okay, so obtain all the benefits as well as direct the use. Okay, what is obtain all the benefits? They're actually using the space. Okay, in a case of an office or warehouse, they're actually using the space. That's what it means by the economic benefits. It doesn't mean they have to sell something there. It just means they're getting the benefit of using the space, as well as right to direct the use of asset, which we'll talk about next. But they need the ability to direct the use as well. So there is something called substantive substitution rights, and under this section, you can, which I actually have, even if an asset is specified, right? Because I remember I said it had to be an identified asset, but even if the asset is specified, a customer does not have the right to use an identified asset if the supplier has the substantive right to substitute the asset throughout the period of use, which is another important thing. A supplier's right to substitute an asset is substantive only if both the following conditions are met. Supplier has the practical ability to substitute the asset, and the supplier would benefit economically from exercising the right to substitute the asset. Okay? What does that mean? Well, think WeWork, or even in a case where a not-for-profit maybe is subleasing some office space from one of the big contributors, to help get off the ground. Yes, they're giving them the right to sublease some space, but the landlord or the lessor or the contributor in this case says, yeah, you can use one of the open offices on the third floor, but you may come in next week. Oh, look, we have to move you because somebody else came in. We're going to put you over here. We're going to put you over there. And if they can bounce you around where you really don't have a home and it's at their discretion, that may not be an identified asset because of the substantive substitution right. So to use the WeWork example, you may be leasing or have an agreement to occupy 3 offices in WeWork, and at the beginning it's suites 201, 202, 203, but a month from now they have a big customer come in and wants everything on the second floor. WeWork has the right, because it'll be in your agreement. WeWork has the right to move you, because they want 10 contiguous offices, so they're going to move you from the second floor to the third floor, and they're going to put this big customer down on the second floor. That may be a substantive substitution right as well. So you need to consider things like that in terms of the ability to substitute. But they gave us a little out here that there are constraints on this right. Most specifically, the one paragraph mentioned there says if the customer cannot determine whether the supplier has a substantive substitution right, you can presume that they don't have the right. Okay, so if it's unclear, if you're unsure, the standard says assume that they don't. The default is they don't have that right, which puts you back under 842. And hey, look, so be it. It is what it is. But that puts you back under 842 because they lack the substantive substitution right. All right, which brings us to another case study. Okay, not-for-profit A has an agreement with University F to utilize 4 of the university's 8 squash courts from 2 to 6 on Tuesdays and Thursdays throughout the school year, and the not-for-profit pays the university $1,000 a month for the use of said courts. Is this a lease? Okay, I know I can't hear you all, but hopefully your minds are turning. And the answer to this, according to my read, is no. It says 4 of the 8 courts. Doesn't say which 4, right? Because the university could say, hey, this week you guys are on 1 through 4. You come in the following week, now you're on 5 through 8. Or next time you're on the odd ones, next time you're on the even ones, because the university, in this case, has retained that right to direct the use, right? Because they've got some other tournaments going on, they've got classes going on, instructional things, whatever it may be. The university has retained the right to direct the use. Now, if it said courts 1 through 4, yes, that would be a lease because all the other things are there. We have consideration, we have a time certain, all the other pieces are there. So if it said courts 1 through 4, yes, that would qualify as a lease. But the fact that you're using 4 of the 8 at their discretion fails to qualify as a lease, and that becomes just a services agreement. They are providing you the use of 4 courts of their choosing. So that does not rise to the level of a lease because you don't direct the use of the asset. So interesting little side piece there. So case study number 4, take a look at this one, and this will actually lead into a polling question. So let's read this first. In the event a landlord shall add buildings to the center, okay, this happened to be a retail client in a mall, okay, in the event the landlord shall add additional buildings to the center or expand any of the buildings currently contained, landlord shall have the right, subject to their right of termination, to require the tenant to relocate its operation. Okay, at the landlord's expense, so on and so forth. Okay, so here's a polling question for you. Would this clause disqualify the contract as a lease? And we have the poll is open now. A very simple yes or no. So would a clause like this disqualify this contract as a lease? All right, coming along pretty well. We have a predominant answer so far. All right, coming along. We got 93% in so far.
Oh, I closed it and here are the results now.
Okay, so we have 71% said yes. All right, well, there was one little clause in that definition that you overlooked. Throughout the period of the lease. Throughout the period of the lease. Okay, this clause says in the event something happens in the future, maybe we add buildings, maybe we expand current buildings, okay, maybe happen in the future. But on day 1 of the lease, that right does not exist. So because the right of substitution, this is a right of substitution, don't get me wrong, it is a right of substitution. But because the right of substitution does not exist throughout the period of the lease, it does not count as substantive. That lease, that right would have had to be there from the beginning, so that's that. Now, apologize, I see that there were some other questions and I can't make this big enough. Hang on. Here we go. Okay, we'll do this. So first one says, does 842 cover land leases? Yes, it absolutely does. I don't remember if there's a slide in here on it, but to answer the question directly, yes. There is no distinction of land leases versus any other kind of lease. Obviously, that comes with some other issues, such as the length of those leases, right? Sometimes, those are, 50, sometimes 99-year leases. You're talking ground leases. You still have to consider it under 842. So yes, land leases absolutely do get covered. All right. Yeah, can the total expense, we covered that one. Can materiality be based on the judgment of the auditor or management, and does it have to be documented? The answer to all of those would be yes, right? Because and as far as our auditing tests, We have our own set of materiality guidelines that we use, but of course, management has to agree, right? Particularly like if we have any uncorrected misstatements, the management has to agree that they are immaterial, right? So, so that's something to consider. And does it have to be documented? Absolutely, right? I think it was SAS 102 or 103 going way back. Not documented equals not done. So absolutely, this has to be documented. But that's not anything unique or new to 842. That's always been the way, and that is still the case. So in that scenario, isn't the donated value a tax deductible expense? The answer is yes. Again, not-for-profits taxes is kind of less of an issue, but yes, the hard money paid for use of the space would appear on your tax return as lease expense. Whereas yes, the donated piece I know is sort of a Schedule M, if you will. Sure, the hard money paid for use of the space would be a deductible item. Does consideration have to be money, or can it be a service for the use of space? Well, yes, non-cash consideration would count as well. You've got your valuation issues there. So what I'm expecting here, or what I think you're talking about, is the nonprofit provide services back to the lessor, I think is what you're saying. Yes, non-cash considerations would count, same as cash. So you would have to handle that. Another good question here: what if the contract says there isn't rent, but a monthly CAM fee must be paid? That's a very interesting one, and I think we have some slides on this. If it's a fixed cost, yes, it very well may count. But if it's a variable cost, I would say no. And CAM costs typically are variable because they are based on the actual expenditures of the landlord. But if it were a fixed cost, yes, unfortunately, I think that would count. And do we amortize consideration over the life of the lease? Well, yes and no, but there's a whole different methodology to it under 842. There is an amortization expense of the right of use asset, but it's in such a way that will result in a straight line expense over the life of the lease. So yes, the consideration is amortized over the life on a straight line method, but it's done by first taking the interest component to the principal amortization off, or accompanied by the right of use amortization. Those two pieces end up creating your short-term lease expense, or I'm sorry, your straight line lease expense. Much like you would calculate under the old rules, you get the same answer, a straight line expense, just you get to it a different way. All right, that caught us up on questions, and sorry I missed those. The window was too small. We covered a polling question. Now, yes, so here's the thing about the CAM costs, okay? This paragraph states consideration in the contract for a lessee includes all payments as described in that paragraph, as well as any of the following payments made during the lease term. Any fixed payments, for example, monthly service charges, right? So to your question about CAM fees, any fixed payment or in substance fixed payments, less any incentives paid, that other than those already included. Now, those already included are the lease costs, what they quantify as rent in the lease, as well as any other fixed payments. So if there is a fixed CAM charge, $3 a foot, $2 a foot, $4 a foot, that would have to be included, as well as any other variable payments dependent on an index or rate measured using the index at the commencement date. So if you have some sort of CPI clause, you would use the CPI rate at commencement as a fixed amount. Typically, you see CPI coming in as the increased amount. So we never know what CPI is going to be the following year, so that wouldn't count. But if it is based on CPI at inception, you would have to use the rate at inception and use that throughout unless there's a modification. So as I mentioned, this would include $3 a square foot for electricity, or $2 a square foot minimum charge for CAM, even though they're not lease components. So even though it's not for use of the space. Because it's a fixed amount, oddly enough, it does have to count. So going back to that first question, if there's a monthly, no rent, but a monthly cam fee, if it's a fixed charge, it would count. It would count, but not if it's a variable charge. Okay. For example, and these are pulled directly from some of my leases. Fixed area common cost per month, commencing in the 19th month, $2,563, which is $25 a year through December 21, and thereafter increasing 3% each January thereafter. Yes, that is a fixed amount, so it has to be counted as part of consideration. Even though it's a CAM charge, because it's fixed, that has to be included in your calculation. Versus a non-binding estimated tax escrow payment per month. So what they're saying, again, commencing in the 19th month, you will pay $1,665 per year, or no, that's the, I don't know if that's the annual amount or monthly amount, but whatever that amount is, that doesn't count because it's a budgeted amount, okay? If it turns out the taxes were actually less than that, you'd get a refund. Or if it was short, they'd have a true up, okay, right? A true up is very common. Because that's a budgeted amount, an estimated amount, even though it's a fixed amount per month, there's a true up that will there'll either be an increase or a refund. That makes it variable, and that doesn't count. Okay, so hopefully you see the difference between the two. Okay, but that's how you handle fixed costs. I see another question came up, which deals with the next slide. Well, actually, one here says, what about quarterly true-ups? Yeah, whether it's quarterly or monthly or annual, whatever it is, since there's a true-up, that makes it variable, that wouldn't count. Okay, so what about quarterly true-ups, like shared spaces that maybe required additional funds paid or maybe a credit? Yep, exactly that. Because there's a true-up, it doesn't count. Okay, because there's a true-up, it doesn't count. That makes it variable, and variable costs do not get included in the calculation. So we did have a question before about ground lease, so with a follow-up question for the old 99-year lease. Okay, a lease of any identified asset, no matter the length of term, is subject to 842, same as any other lease. Therefore, the financing tests must be applied. And to this question, yes, it is quite possible that the present value of the payments under a lease approximate substantially all of the current fair value of the land. Question was, so a 99-year land lease would have to be considered a capital lease? Not exactly, don't have to be, but very well may be, just based on all the payments being made and the present value of those, particularly if you're using a risk-free rate, which would be a very low discount rate. It is quite possible that a land lease, even though you'll never take title, it is quite possible that a land lease would be considered a capital lease, although they call them finance leases now. Okay, next one, lease 5-year automatic 1-year renewals to either party terminates. Well, we did address that. You still have to look at the likelihood because you have the right to exercise it. Okay. Now, although it does say either party has the right to terminate, well, if the lessor, if the landlord has the right to terminate, that you have to consider to happen. If it's beyond your control, you have to consider that to occur because it's beyond your control. So in your case there, it would be 5 years. It would be 5 years. All right, I think we're a little, okay. However, this is an interesting one, particularly in the not-for-profit area. There is a clause in the standard that certain leases involving governmental units should all be classified as operating leases if certain conditions are met, which is primarily that the asset is a permanent structure that's part of a bigger facility, and a similar asset could not be purchased or leased in the same service area from a non-governmental unit of authority. This is your airports and train terminals, bus terminals, things like that. this was actually prevalent enough that they put a separate clause in there. If you are renting from a governmental unit, again, think airport, bus terminal, train terminal, those are all operating leases. Does 842 consider a sublease of a land lease with the lessor would also become a lessor? I'm not sure if you're referring to sale leaseback, because you either are a lessee or a lessor, unless it's a sale leaseback. There are sale leaseback rules in 842. Not time enough to cover them today, but yes, there are sale and leaseback rules to cover. The other comment I'll make is subleases do need to be addressed separately. There is no netting of subleases. So if you are in a sublease situation, you could be a lessee on one side and a lessor on the other side. They do need to be considered separately. You cannot net subleases under 842. Okay, I'll try to pick up the page. We only have a few minutes left. Embedded leases, talked about these before. These are components within contracts that entail the use of a particular asset where the user has control. And you might be surprised at some of the contracts that often contain embedded leases, even though they don't contain the word lease. Okay, example, not-for-profit has a contract with a supplier that provides 20 laptops for use by students at the not-for-profit facility for 2 years. Contract includes unlimited maintenance on the laptops. At the end of the 2 years, the supplier takes the laptops back. Is this a lease? Is this a lease? Okay. I don't have an answer posted. I see this as yes. Okay. You have a contract that has 20 laptops. There are your identified assets. They're in your facility. You have the right to use them, but it also includes unlimited maintenance. Okay. So you will then be required to bifurcate that contract. How much of the payment is towards the laptop itself? How much is towards the maintenance? And you have to count the piece attributable to the laptops in your calculation of 842. There is a practical expedient to not separate the lease and non-lease components. So you would have to take the maintenance piece and include that in your calculation. Obviously, you're going to get a bigger liability, a bigger number. May also push you into finance lease territory because the net present value with payments will be high, possibly even higher than the lease, the asset cost. But nevertheless, that's the option you took. So this is a classic embedded lease. You have use of equipment as well as maintenance in the same contract, and you do have a requirement to isolate the equipment cost versus the maintenance cost and deal with them accordingly. Another question, are there any tools you can recommend to help us implement? It's honestly professional judgment. It's knowing the standard, reading the standard. But I'll repeat, if you have these unusual situations, reach out. We are happy to help you address them. Okay, but otherwise, no, it's really professional judgment and kind of using your noodle. But my team does remain available to address specific unusual type questions. Okay, here's another situation. Okay, this contract calls for the use of 400 square feet. It actually said square footage 400. Okay, subject to the timely payment of the storage fees, right? Client's inventory will be stored in a processing center. Okay, secured storage, climate-controlled storage may be available for additional fee. Then they talk about liability for the safety of the stuff. Service providers only liable for the number of kits. If they receive it by the pallet, they're only liable for the number of pallets received, and so on and so forth. Okay. Question is this a lease? Okay, and I think that's polling question 3. Ali, is that polling question 3?
Yes.
Okay.
All right, here we are. What is needed to have the right to control the asset under a
It's not.
lease? Oh,
Okay,
sorry.
right. So no, leave the poll open. Leave the poll open. Okay. In this case, this is not a lease because all it says is you're entitled to 400 square feet. It doesn't say which 400 square feet. Okay. The warehouse can and likely will move your materials around, move your inventory around to best suit them. This one like this does not qualify as a lease. Okay, so now back to the poll. Right. So which two factors do you need? The right to obtain substantially all the economic benefits from the asset, and or the right to direct the use. Okay, we've got only 41% voted so far. So let's.
And just a reminder, this is the third out of the fourth polling question, so please be sure to answer.
And I promise to get to the fourth, so everybody gets their credit. All right, 61% getting there, 64. Want people to get their credit, so let's.
Yep, we'll leave it open.
The answers coming in pretty good so far.
All right, we'll close it out now. And here are the results.
All right, so with 93% voting, 71% said both, which is the correct answer. So, I mean, okay, each one of those are sort of an option, but no, you actually need both of those, and you can go back to the slide at your leisure. Both are required to have the right to control. Right to control.
Your PowerPoint reset, Al, just so you know.
Oh yeah, look at that. Okay, yeah, I'll get back to that. Now another question came in. There was no consideration in your better lease example. Apologies for that. Yes, it should. If there's no consideration, right, that doesn't count. I probably should have thrown an amount in there. To the extent there was consideration, that would be a lease. My point on that one was, even though the asset was kind of wrapped into other pieces in the same contract, that doesn't exclude it. You have to look within a contract to see if there's an embedded asset in there. So yeah, apologies for leaving out the amount of consideration. Presuming there was consideration for that, you would have to account for at least the portion of the cost attributable to the laptop, and potentially both. All right, so let's get back into here. Come on. There we go. Yeah, polling question number 3. There we go. Okay, so rate implicit in the lease. I've got a few slides left. This is an interesting one. Okay, so in determining the discount rate to use, there's 3 tiers. There is the rate implicit in the lease, there is the incremental borrowing rate, and there's a risk-free rate available for non-public companies. Okay, the rate implicit in the lease is defined as the rate of interest that at a given date causes the aggregate present value of all the lease payments plus the amount they expect to derive from the asset following into the lease term, also known as residual, to equal the fair value of the underlying asset minus any related investment tax credits and any deferred cost. Basically, what rate would get the payments back to the original cost of the asset, which would include your payments plus any residual. Now, I will tell you, on a real estate lease, you're not going to get it. Real estate leases just don't work that way. You're not going to get one. Don't call the landlord and ask what the implicit rate is. You're not going to get it because they don't even know it. This is very applicable in equipment leases. Sometimes it's even stated in equipment leases. Okay, I actually have an example here. I won't run through the example in the interest of time. You can look at it on your own. But with these pieces here, and this is your classic car lease for those that are familiar. I've signed quite a few of these in my day. There is information in here that can get you the rate implicit in the lease, and here's the t-value calculation of it, and you can look at it on your own. But if you're able to calculate the rate, you're supposed to use it. Okay, an update that came out last year says if the rate implicit in the lease is known, you should use it. Okay, choosing an incremental borrowing rate, I'll just touch this quickly. To choose the incremental borrowing rate, it is the rate of interest a lessee would have to pay to borrow on a collateralized basis over a similar term, an amount equal to the lease payments in a similar environment. Okay, this is a change from the previous standard. The previous standard was simply borrowing. It was an unsecured borrowing, and as you can imagine, an unsecured borrowing would typically come with a higher rate. 842 says borrow on a collateralized basis, okay, which will get you a lower rate, but try and get one, okay? Banks so far have been a bit reluctant to offer such rates, lest it be construed as an offer. So clients so far have not had a great success, mild success. A couple of people have gotten it, but most banks are reluctant to quote a rate lest it be construed as an offer. And here's just a note, this differs because 840 allowed an unsecured rate in lieu of a secured rate. Okay. And there isn't a whole lot of guidance on calculating this number, though it is clear that the weighted average cost of capital is not permitted. That we do know. All right, let me just pop through here quick. You can use, this is something that came out last year, non-public entities can use a risk-free rate based on class of asset. It used to be all or nothing. Now it's just class of asset if you want. But of course, if the rate implicit in the lease is known, you have to use that. Transition rules are similar to other rules. Okay, this is the one I mentioned before. You may choose not to separate lease and non-lease components. Take that embedded lease example. The pro is that it's easier to account for the lease as a whole, but the con is you may get yourself into finance lease category. And remember, disclose is super, super important. And with that, I'll bring us to our final polling question.
Here we have, do you prefer lease accounting under ASC 840 or ASC 842?
And of course, we have our people just here for the credits. So Ali, I like those names too, and we're gonna cancel their credit. And just a little anecdote while these answers are coming in. Had a meeting with a law firm a couple of years ago when this thing sort of first came out, and they wanted to understand what the heck was going on. So I went and explained it to them. And one of the lawyers looks me square in the eye and says, that makes perfect sense. Why didn't we do this from the beginning? And, you know, obviously opinions vary, but I think back in 1976, I think 1976 when FAS 13 came out, which is our current rules, I think the consensus was because it's a little bit easier to get out of a lease than other contracts, right? You know, give back the space, you know, maybe a small penalty or something like that, that it wasn't as binding as some other contracts. Again, this is just conjecture. Have no idea what the mindset was. I didn't read the basis for conclusions in 1976, since I was just a wee lad, but I was around in 76. All right, doing pretty well, 93% there. Okay, yeah, so we are at 1 o'clock, even though we started a couple minutes late. We are at 1 o'clock, so for those that did get their fourth polling question in, if you'd like to depart, you may. I do have just a couple more slides, just another couple of illustrations. You know, you're welcome to stay around. It's less than 5 minutes if you are interested in staying around. But otherwise, if you've had your 4 questions, I guess, Ali, it hasn't moved. I guess you can close that one out.
Okay, yep, I closed it down. Do you want me to share the results again?
Well, I'll just read them off. 54% like the old way, 30% like the new way, and 16 are just here for the credits. All right. Again, thank you all for listening. Again, I remain available for any questions you may have. Shoot them off an email, grab me at Teams, whatever. For those unusual type things. But for the most part, it is pretty straightforward. So you shouldn't have much of an issue, handling this for your clients. And as I said, I have just a couple more slides if anybody wants to stick around. Take a look at this one. I just thought this one was interesting. We still got 30 something. I'll keep going. So they call it a license agreement. Okay. So this license agreement, okay, has a date. There's a licensor, licensee. Licensor is the owner of a commercial cooperative unit located in New York City. Licensee desires to license the parcel, okay, shown in Exhibit 1, to use and occupy for the retail sale of lingerie, swimwear, and other items, okay, and for no other purpose. Okay, sounds like a store, right? Okay, license fee, okay, commencing on the earlier of January 15th or the date they open for the public. The rent commencement date, oops, they slipped. They called it rent instead of a license fee. Okay, the rent commencement shall be 13,000, and it goes up, so on and so forth, all the different types of things. And there's a clause that says, not a lease. It is hereby declared by and between this license is not a lease and is not the intention to create a lease. Okay. Oh yeah, that was it. They actually had a clause in there. This is not a lease. Okay, well, let's go back. We have an identified asset, right? It's the amount, the item shown crosshatched on the floor plan in Exhibit 1. We're going to use it to occupy it for the retail sale of lingerie, swimwear, and other items. Okay, so we have the right to control it. We're directing the use. The licensee is going to use it to sell their apparel. Okay, we have consideration. There was also a term somewhere in here, right? Because talks about the rent's commencement date through March 19, and yeah, at some point, whatever it ends at, we have a time certain, right? We have a period of time, an exchange, identified asset for a period of time, in exchange for consideration. We control the use of the asset. That's a lease. That's a lease. Despite the fact that they say it's not a lease, it's a lease. It's a lease. So the new standard is very, very much principles driven. If it walks like a lease and talks like a lease, it's a lease. And I just found in reading this contract from a client of ours, I found it very interesting that they went so far to say it's not a lease, but you know what? It really, really is, because you had all those components. So keep that in mind. Good luck to you. I'll say again, anybody has any questions, feel free to reach out, and enjoy the first day and hopefully many days of summer. Take care.